Welcome to another episode of Quest for Twice. Today is the first day of February. I'm going to do a deep dive on a new company that is called ETRN Midstream. I will also provide a review of the earning update from ATKR. So the main business of ETRN, ticker ETRN, is in natural gas gathering and transmission. So on this slide, the figure on the left shows the map view of ETRN's transmission pipeline and storage. The figure on the right-hand side shows the gathering system overlaid on the transmission system. So what is transmission versus gathering? Transmission usually cross from one state to another with a limited number of inlets and outlets. It is regulated by FERC. For gathering system, usually it collects production from well pads and feed into a central location, then feed into a transmission pipeline. So ETRN has 950 miles of interstate pipeline. That's for transmission purpose, with 4.4 BCF per day capacity and 14 BCF gas storage capacity. It has several gathering systems, including Ohio Utica gathering with a minimum volume commitment, MVC. That system has about 210 miles high pressure pipeline. It also has another system called Eureka and Hornet gathering system with 280 miles of high pressure pipeline and 1 BCF per day MVC. Lastly, the largest gathering system for ETRN is Pennsylvania and West Virginia gathering, including 680 miles of high pressure pipeline with 3 to 4 BCF per day MVC from EQT. So for pipeline company, the pipeline and the storage is their valuable asset, and the growth is really about growing their asset. So what are the growth opportunities for ETRN? The first one is Ohio Valley Connector expansion for $160 million that can increase capacity by 350 million cubic feet per day. It's also getting into the water transportation business with a 10-year water service agreement with the EQT starting at the first quarter of 2022. ETRN spent $70 million of capex last year to build out the water infrastructure. The biggest opportunity is a Mountain Valley pipeline. It's a 300-mile, 42-inch interstate pipeline costing about $6.6 billion with a 2 BCF per day capacity and additional compression expansion opportunity. The map on the right shows the route of the Mountain Valley pipeline, that's in blue color. Related to MVP is a Hammerhead gathering to feed MVP with Ohio gas production with about 1.6 BCF per day capacity and a budget of about $500 million. Lastly, there is an extension opportunity for MVP called MVP Southgate, costing also about $500 million. So if ETRN can build these pipelines and their expansions, then it will increase the value of its asset. We'll be able to collect the revenue using these assets. According to ETRN, Mountain Valley pipeline is 94% complete. However, there are many litigations against this pipeline from environmental NGOs. So those legal cases have prevented ETRN from completing this pipeline and putting into service So I'm going to discuss that risk later. Next, let's look at the ETRN's revenue components. 30% of its revenue is volumetric based. So the shippers pay based on the amount of gas ETRN moves in the system. The remaining 70% is take or pay. That means the revenue is guaranteed within the contract term. Even if the shipper doesn't use the capacity, the shipper still has to pay based on the contract amount. 67% of revenue from gathering system, and 29% from transmission, and 4% from water transportation. For operation margin, about 52% margin from gathering, 71% from transmission, and 10% from water. However, there is an important note about the revenue for gathering system. That is because gathering margin is lower than what I would consider a realistic number, because deferred revenue is not in the denominator. So operating profit is in the numerator, revenue is in the denominator. But there is a term called deferred revenue that is not in the denominator. So what is a deferred revenue? It is a surplus cash payment over the minimum volume commitment made by the shippers. As a reminder, almost all the gathering system of ETRN has a MVC. So although the customers pay ETRN to ship that volume, but the additional volume and the associated fee does not go into the profit and loss statement, therefore does not show up as part of the revenue. It shows up as a cash flow and a future liability. So the revenue and the operating profit does not fully reflect the profitability of ETRN because of the deferred revenue. Now let's review ETRN's system capacity and capital expenditures. So we can see in this table, the first row is gathering volume by firm commitment. The unit is billion BTU per day. In 2019, that capacity was over 3,300. It increased to over 4,600 in 2020, over 5,200 in 2021, and about 5,200 in 2022. The gathering capacity for fee-based is about 4,500 in 2019, over 3,500 in 2020, and over 3,000 in 2021, and about 2,600 in 2022. So if we add those two components together for the gathering volume, the total volume in 2019 was a little over 7,800. Fast forward to 2022, the total volume is still about 7,800, very little change. Then let's compare and contrast with the transmission volume. In 2019, that was over 2,900. Then slowly increased to 2,948 in 2020, 2,971 in 2021, and over 3,100 in 2022. So transmission volume and capacity has been steadily and slowly increasing in the last few years, with stable gathering capacity and volume the last few years. Why is that interesting? Because now let's examine the capex for gathering system. ETRN spent about $835 million in 2019 on the gathering system, and $345 million in 2020, $224 million in 2021, and $255 million in 2022. So ETRN has been spending hundreds of millions of dollars on the gathering system, but the volume and capacity for the gathering system has been fairly steady. In other words, ETRN has to spend millions of dollars on the gathering system just to keep the total capacities and the volume stable. In comparison, the capex on the transmission system is fairly small, with the biggest expenditure of $59 million in 2019, then less than $50 million in the last 3 years, if we don't count the expenditure on the Mountain Valley pipeline. That's a different animal. I also listed the capex for the water system. So the main takeaway is gathering volume barely moved from 2019 to 2022, despite the hundreds of millions of dollars expenditure each year. Therefore, in my opinion, the maintenance capital is about $300 million a year just to keep the shipment volume steady on its gathering system. With that information, we can analyze ETRN's cash flow. So for last year, the estimated EBITDA is about 1.05 billion, with a deferred revenue about $350 million. As I mentioned on the last slide, I calculated the maintenance capital was about $300 million. The annual interest payment is about $400 million, with a negligible tax payment due to write-down from the MVP project. So if we add the deferred revenue to EBITDA, then subtract the maintenance capital, interest payment, we get a distributable cash flow of $700 billion a year. Currently, the company pays $320 million a year in dividend, with a growth capex about $260 billion if we don't count the MVP and related projects. So the main takeaway is that the dividend is safely covered by the DCF, and there will be even free cash flow left after dividend payment and capital payment in hundreds of millions of dollars. The management stated that the FCF will be used to reduce debt because it does have a high amount of debt. The long-term debt is about 6.3 billion plus a revolving credit of 0.4 billion. So if we use the total debt divided by EBITDA plus deferred revenue, we get about 4.8. That is fairly high, and the credit agencies give ETRN a non-investment grade for its bond, with a credit rating of BB-. So one may ask, what about the number of growth projects I mentioned earlier, including MVP, Hammerhead, and other expansion projects? So that's shown in the table on the top right. The good news is MVP is 94% complete already, and Hammerhead and other expansion projects are tied to MVP completion. So the current expenditure level is low. ETRN also gave estimated annual incremental EBITDA from those 3 projects. So we can see for Hammerhead, capital versus EBITDA ratio is about 7, and same with the EEP project. The MVP project has a ratio over 15. So with the perfect hindsight, MVP was a mistake. However, most of the money has been spent. The project is almost complete. So my investment thesis is really based on valuation level. ETRN's EV over DCF is about 15 at $7.15 per share. It's about the same as Kinder Morgan. However, I can collect a high dividend with a yield of 8.4% while waiting for MVP, because the current DCF and the dividend does not take into account of the potential contribution from the MVP project. For Kinder Morgan, the dividend yield is 5.9%. That's because the company is not as highly leveraged as ETRN. So what are the risks? The biggest risk is related to MVP, which is being litigated. If ETRN wins, it will add about $300 million of EBITDA eventually, with less than $1 billion of additional capital. So that ratio is about 3 and very attractive. On the other hand, if ETRN loses or the case drags on, the $6 billion investment will be wasted. Of course, that the money has already been spent. The more important risk is if the project drags on for years, and then ETRN will still have to spend millions of dollars each year while the project is in limbo. Another threat is to the DCF. As I mentioned, ETRN is heavily in debt with the BB- rating. If any major accident happens, it will not have the financial resource for the additional loss or liability. Just for reference, its 2020 EBITDA was about $520 million. That's almost half as much as the EBITDA expected from 2022. So if for any reason the EBITDA or cash flow is significantly reduced, then ETRN will be in financial distress. Another threat is a gathering system needs a continuous investment because of a natural production decline. That's already reflected in the $300 million of maintenance capital I calculated before. However, if ETRN runs out of room to deploy the additional maintenance capital, then its revenue and DCF will be reduced. The flip side is the opportunity related to the Appalachia region, which has the lowest cost base for non-associated gas. The regional price discount to Henry Hub makes a long-lasting and compelling case for midstream assets, because currently the entire region is export capacity constrained. A lot of producers have to cut back on their development plan because there isn't enough export capacity out of the Appalachian region. Finally, there is a concentration risk because EQT makes up about 70% of ETRN revenue. Putting everything together, I think ETRN is attractively priced with a significant upside from MVP completion and in service. If the upside doesn't materialize, I believe it has a robust cash flow to handle the dividend. But obviously, if anything goes wrong, then that dividend will be at jeopardy. Now, let me switch gear and talk about the outstanding fiscal first quarter delivered by Equinor. So we can see in this table, Equinor had total sales of $834 million in first quarter, compared to $841 1 year ago. But if we look under the hood, it had more than $100 million of sales decline due to price reduction. As I mentioned in the past, Equinor enjoyed a much higher sales price in the last 2 years because of the housing boom. Now the price environment is normalizing, and its product price is declining. So that has been forecasted and guided by its management in the past repetitively. However, that large sales decline due to price reduction was 55% offset by new revenue from acquisitions in the last year. As a result, its total revenue reduction was fairly small from 1 year ago. That's also because of the organic volume was up by 5%. So if we look at the two different segments, the electrical segment margin softened slightly at 38.2% compared to 43.6% 1 year ago. The segment revenue only declined by $3 million. That's because the acquisition and the volume growth contributed more than the sales decline due to price decline. Its mechanical segment also delivered very impressive results with revenue 195 million compared to 200 million 1 year ago. What's outstanding is its segment margin was 17.1%, much higher than 13.7% 1 year ago. So as a result, the price decline did not compress the profit margin for Ichor. It delivered EBITDA of $264 million in first quarter compared to $283 million 1 year ago. So the fear in the past was with the price normalization, its sales and profit would drop off a cliff. But it turns out not being the case, because Ichor protected its profit margin because it retains the part of the price increase in the past permanently. So it's not going back to the price that's before the pandemic related housing boom in the last 3 years. As a result, the management raised its full year EBITDA again by $100 million compared to prior guidance given at the end of the fourth quarter, which was already raised by $50 million compared to the prior guidance. And the second quarter EBITDA guided around $255 million. That's a significant drop from $360 million in the second quarter of last year. But it's similar as the Q1 EBITDA. And if we look at the full year guidance, now the center point is about $1 billion, implying an average $250 million of EBITDA each quarter. So I do believe its long-term steady state EBITDA will be significantly greater than $600 million run rate guided a couple of years ago. The management also raised its fiscal year EPS to $16.80 compared to $14 guided 1 quarter ago. So overall outstanding quarter given the cooling real estate market environment. Now let's look at its valuation. So using $750 million run rate EBITDA, its current EV over EBITDA ratio will be 8.2. That's not factoring in the impact from infrastructure bill, and that valuation metric is significantly lower than its peers of Hubble and Amazon. Its PE ratio 8.6 is also very cheap. So my original investment case is still valid. This concludes this latest episode of Quest for Twice. Until next time, happy investing.